Hi, everyone. Thanks for joining us today. Happy St. Patrick's Day. My name is Brett Davis. I am a Senior Vice President here at the Exeter Group of Companies, and I oversee the Trust Operations Group. Today, we want to thank you for joining us to unravel the mysteries of holding IRAs in retirement plans, using 1031 exchanges to defer taxes on real estate transactions, and to learn how to build a tool set and a system to assist you in making the most rigorous, high quality, and durable property purchases for your retirement plans and your non-retirement plan purchases in real estate. So you'll be hearing from three of us today. First of all, again, I'm Brett Davis. I will cover retirement plans, what type of properties you can purchase in retirement plans, and I'll build hopefully what is a compelling case for using retirement plans to purchase real estate and holding real estate in retirement plans. You'll also hear from Hiba Exeter. She is vice president here at the Exeter Group of Companies, and she'll talk about in depth 1031 exchanges and how to use that rule to defer taxes on multiple property purchases. And then we have a special guest, Johnny Lynum. He's the founder of Operation Invest and REI Genius. He's going to walk you through a set of tools and a system to use when you're making purchases. Now, that's whether they're in retirement plans or external to retirement plans, taxable accounts. But you're going to find that having a system in place and using the tools that he shares with you are going to be very important, whether you're a novice, whether you're just getting started in real estate investing in retirement plans, or whether you're advising people and are already an expert. All right, let's talk a little bit about Exeter Trust Company so you know who we are. We are an independent trust company, and we hold a Wyoming Division of Banking charter. That means we're regulated, and we are regulated vigorously by the Wyoming Division of Banking. That means we have to be truthful. That means we have to be transparent with our transactions and what we're doing, and that we're looked at closely by a group of very good regulators. It means something else as well. It means that we have access to a pool of data, a pool of information, best practices that the Division of Banking puts out there from everybody, us and other people that they regulate. So the processes and actions and operations that we use are best in class. Right. We also have insurance. We have a fidelity bond. We have errors and omission insurance. We have financial institution blanket bond, and every insurance that can cover us. When I think about our lines of business, we offer self-directed IRAs, and we specialize in holding alternative investments, one of which is real estate. We also offer directed trusteeship, administrative trusteeship for personal trusts that fit our mold. We offer custody services for specialty holding escrows and for land trusts. The other side of our business is as a 1031 qualified intermediary for exchanges. And you're going to hear Hiba talk about that in pretty much detail, so I won't cover that too much here. So that is Exeter Trust Company in summary. I want to start by talking a little bit about why I interpret you're here. When I look through our list of people who are attending, I see some novice investors that I know. I see some people who have just gotten into real estate investing. I see some advisors who are advising people, and I see a few people who are using us who I consider expert real estate investors, right? So many of you have probably thought over time, wow, my 401k, my retirement plans are invested in mutual funds, they're invested in stocks, and I'm doing okay, but I know real estate, or I want to get into real estate. Wouldn't it be wonderful if I could invest in that piece of property down the street that has awesome income flow into my retirement plan? And we're going to tell you today you can. We're going to show you how to do it. But expertise, it's important to gain expertise around this. It's just like any other thing, doctor, engineer. You have to gain expertise and you have to have a system in order to do it correctly and do it well. And, that takes some time, takes some effort. Some people argue it takes 10,000 hours, may take less, may take longer. But once you gain that expertise, once you have your back-tested system in place, once you have your tools, you see things that are more obvious to you than they are to novices or to people who haven't done this type of investing before. The opportunities are easier to find and see. And then finally, you're able to invest in what you know. And, immortal words from Peter Lynch: invest in what you know what you own, and know why you own it. So once you hit that level where you can start investing in real estate, why not do it? It's a vital part of your retirement plan portfolio or your portfolio outside of retirement plans. Next slide, please. So what types of real estate can you invest in a retirement plan? It's very, very broad. First of all, actual properties down the street, retail dwellings for long-term or short-term leases or rents are a possibility in retirement plans. Now, these are not properties you already own. You can't own them already. They have to be acquired from a non-family third-party individual. All right. But retail dwellings, which produce income, are a possibility. You can also purchase commercial properties, such as strip malls, properties that have businesses on them. You, of course, cannot run the business, but you can purchase the property under the business, and the business can pay you rents or leases. You can purchase warehouses. And the point of this is it's very broad, right? You can purchase retail properties as well as commercial dwellings. You can also purchase raw land, and it could be raw land for speculation. Perhaps there's a piece of land that you anticipate a developer will be wanting to purchase down the line. Buy it into your IRA, sell it to the developer down the line for a profit. And that's a possibility. You can also develop spec land. You can put easements on it. You can prep it for a developer to make it more attractive and then sell it. Raw land is very flexible. You can also lease out the game rights. Perhaps it has a lake on it. Perhaps you lease it to fishermen, right? And then mineral production. If you have land that you acquire that has minerals on it, you can lease off the mineral rights to companies as well. So land on the ground purchased into an IRA is very flexible. But again, I want to mention you got to have a process in place. You have to have a system. You're going to hear Johnny talk about that a lot. And then one final point I want to make, and this is a very broad point. Income generated by the real estate held within the IRA has to come back directly to the IRA. It has to skip your hands as the owner of the IRA. You can't touch it. Once that money comes into the IRA, it's deferred. But if you touch it before it comes in, it's tainted. It's considered a prohibited transaction and jeopardizes the entire tax deferred status of your account. So it's very important to remember that income generated by properties held in an IRA must come back into the IRA and bypass you completely. On the flip side, maintenance of the properties that are held in IRAs. Say you hold a house that's producing income through rentals, and a piece of the roof falls off. It happens here in Wyoming all the time with the wind. The replacement of that piece of the roof, the replacement of those shingles, has to be paid for by the IRA, right? You can't write a check personally to maintain property in an IRA. It must come from funds in the IRA. All right. So that's land, actual land out there. Let's talk about lending from an IRA, right? You're probably thinking, well, that's a loan. IRAs can't do loans. 401ks can, but IRAs can. When I say lending, I mean making a loan from the IRA to an individual or to a business or to a commercial entity out there. The IRA basically sends money to the individual company, and they send the money back to the IRA in terms of interest and principal, right? However, you can secure that. and this is where the real estate comes in. You can secure that loan with a deed of trust, to a property that the borrower owns. And in so doing, you've secured the loan and you have access to the real estate should the borrower default. So very possible to invest in a deed of trust with IRA funds. Delaware statutory trusts are also a possibility. Delaware statutory trusts are a unique vehicle. They are a fractional interest in an actual property or a set of properties that's brokered by a company, by a real estate broker, right? So your IRA would send funds out to the Delaware Statutory Trust Company, to the broker, and own a percentage interest in a broader property. And many other investors as well own percentage interests in that property, right? So that's direct participation in that particular property. REITs, real estate investment trusts, are also a possibility. And many of you probably know of REITs already. And you're saying, well, we invest in REITs. We invest them through Schwab, through our Fidelity account, through our Interactive Brokers account. And that's a possibility. There are traded REITs. But I want to point out what happens to a traded REIT when the market changes, right? Let's consider the multiple days that NVIDIA has pulled down the entire market with it for no good reason. REITs have come down in value just as much as everything else has. Private REITs, unlisted REITs are also a possibility. And those don't fluctuate like the market does, right? They're private investments. They're not listed, and they are viable real estate investments to add to your real estate portfolio within an IRA. Okay. And then finally, funds. I'm going to talk about funds a little more deeply at the end of my presentation. But private funds that invest in real estate are also a possibility. And they're great for investors who are new to real estate investing in IRAs. The reason why is you can use a professional manager in their fund to manage that piece of your portfolio. You don't have to go into a direct piece of real estate before you're ready or before your system is perfected or back tested, right? So private funds are a great way for new investors to get into real estate and to diversify your portfolio into real estate. Okay, so we've talked about what can be done. Direct properties, REITs, income producing properties, commercial properties. It's very broad. I'm going to take a right turn now. And we're going to talk about a study that was done a while back. So it started in 2015 by a gentleman named Oscar Jorda. And he was asked by the San Francisco Federal Reserve to take a look at four major asset classes over time and figure out which ones are the most risky, which ones have the best average return, a lot of factors. Well, Jorda put together a team, and he found that he had data going back to 1870 on 16 different countries. So he expanded the breadth of that study. And he created what is known as a very thick document called the rate of return on everything. So what he found, he had two findings in that study, which took 5 years to complete. Both of these findings were surprises. Okay, and the first one I'm going to talk about right now. One of the things he looked at or attempted to find was the average annual return on real estate, equities, which are basically traded securities across all these 16 nations, government bonds, or the nation's equivalent of which, and treasuries, or that nation's equivalent of which. And he found some normal things, which I think everybody who understands economics expected him to find. He found that treasuries had a low average annual return, right? Most of the time they do. They're pretty stable. It matches the risk return trade-off. Low risk, low return. Bonds, 2.5%, pretty much was the same thing. Equities, he found, turned around 7%. The surprise over the long haul was that real estate returned more than equities did, right? So real estate has a higher average annual return across the long haul than equities, and that surprised everyone. Now, Of course, there's some error to this study, of course, but the point is, real estate, when you have a system in place and choose durable, high quality properties, produce similar returns to equities. So that makes sense, right? You should include real estate alongside equities and mutual funds in your retirement plan portfolio. Okay, why else should you hold real estate? Next slide, please. Well, further asset diversification. When we listen to our CPAs, when we listen to our CFAs, when we listen to someone we're using as a CFP, they say diversify your portfolio. Diversify your portfolio by investing in a large array of mutual funds with different strategies, or a large array of equities from different industries, right? We strive to diversify. Well, real estate can diversify into a completely different asset category, all right? And that's where it gains its place in your portfolio as a high quality investment, right? Also, real estate is not correlated with broader indexes. It doesn't move like the S&P does every day. It doesn't move along with the NASDAQ. It doesn't move along with the Dow. Real estate moves along to the beat of its own drummer, right? It is not correlated with the ups and downs in the market. We just talked about long-term appreciation. Over the long haul, real estate can return, granted you go into a good property. It can return the same thing that equities can, right? And then variant of outcome. Well, what can you do with real estate in an IRA? Well, we've already talked about renting and leasing properties from your IRA. It's a possibility. You can also use the tools out there that exist, Airbnb, VRBO. You can utilize those alongside your retirement plan to manage that property. You can sell a property once it's done returning its income stream, or you can sell it in any opportune time you find that makes sense. You can also improve a property. We have a very astute client who invests in distressed properties. His IRA pays to improve the properties and fix what's wrong with the properties. Then he sells them, makes a very good income on it to the IRA. So you can improve properties. And again, you can improve raw land as well. And then in the end, when you're ready to take a distribution, your question is probably, well, if I have a piece of raw land in there and it's gained a lot of quality and value, how do I get my money out? Well, of course, you could sell the land, right? But it's also possible to distribute property to yourself. And there's some prohibited transaction rules which say you can't sell a property to yourself or buy a property from yourself. However, you can distribute in-kind a property to yourself. You would ask your custodian to do that, and they would produce 1099-R for you. And that's what would prove to the IRS that you took a distribution of X amount of value. Okay. So it's possible to distribute the value. You don't have to sell the real estate. But I want to go back to 2 points. First point, you have to have a system in place to identify the right property. You have to have models. You have to have tools to do it correctly. And then finally, I want to talk about how the title looks to the property. This is probably the most important thing, other than making sure that the income comes into the IRA and out of the IRA for maintenance. Titles to direct real estate that are held in IRA must be in the name of the custodian. In our case, Exeter Trust Company custodian for BDavis IRA. Right? That's how the ownership of the property remains deferred. Right? And the tax identification number of the property ends up being that's associated with property ends up being your custodian's tax identification number. And that tax identification number is a special custodial tax identification number, which keeps things under it deferred. It's a flag to the IRS that that asset is a deferred vehicle. Okay, next slide. I would say that the most important reason to invest in real estate was also touched on by Oscar George's study. So these are two charts, one from France, one from the USA, and all the charts in his study around this look very similar. The red line is the real estate equities that are traded in that country. Okay, that's the red line. These are listed securities. The green line is real estate on the ground. It's commercial buildings, it's houses, it's real estate on the ground, right? You're going to see a big difference between these two lines. The red line looks a lot like a stock chart, right? It's up and down, big peaks, big valleys, sharp. That curve denotes a lot of risk and a lot of reward. The green line also shows a lot of risk and reward, but it's a much smoother curve. So what Jorda and his group found, next slide, please, was that the volatility of real estate is much like that of government bonds. It's not like that of equities. It's a little more than treasuries. But if you find a good piece of real estate, high quality and durable, and you place it in your retirement portfolio, you are getting the same average return with a lower volatility than equities, right? Let me say that again. So you're getting the same average return that you might with an equity, depending, yet with lower volatility. That's a great thing. And that diversifies your portfolio. So those are the reasons to go into real estate, regardless of whether it's a fund, a REIT, a piece of property. As long as you've done your homework, real estate has a potential to lower your volatility and keep your return at the same as a bucket of equities. Okay, the last thing I'm going to talk about is funds, real estate funds. Next slide, please. These are important because, again, they are attractive to new investors, but they can be attractive to advisors as well, managing a set of properties or managing a set of IRAs. Why are they valuable? Well, real estate funds which utilize Reg D, Regulation D, make a promise that they're not going to solicit to certain individuals, right? So their advertising is limited, but for that limitation, they don't have to report consistently to the SEC, which is laborious, very labor intensive. All right. And that's important that I'll get to in a minute. But these funds can further your asset diversification potential, just like a piece of real estate can, right? These funds are not correlated with the broader markets or with the traded markets, so correlation is not there. I do want to mention that non-correlation is not the same as durability. You're going to find Johnny has a great definition of durability and a great way to reach durable properties. Because these funds aren't listed, its value is not subject to these violent price fluctuations that equities are. So if your stomach's not in the equities game, these can definitely help your IRA and help you manage your investments in your IRA in a more psychological manner. Very important. These funds are managed professionally by people who are real estate people. They know what they're doing with real estate, and that's why they've gotten into the real estate game. They also have, last I looked, there was 8,000 Reg D real estate funds out there. So voluminous, and there's just as many varieties and types of focuses in those funds as there are funds. And then within those focuses, there's different creative model strategies for finding the properties. But the most important thing about these funds, and the most important thing about having a system to identify the fund manager and the right fund for you, is that the fund manager has full autonomy. And what I mean by that is that there's no board of directors, there's no clients concerned about the price of the fund that's just gone down and been pulled down by NVIDIA or the rest of the market. These managers have full autonomy to spend their time looking for properties, managing properties, and finding the most durable and high quality properties. And I want to leave you with a quote from Sam Zell. Very spicy individual, but perhaps one of the best real estate investors of all time. When he was acquiring one of his private companies that invested in real estate, he was going to take it private. And he said, just by being private, the culture will change. We won't be forced to make decisions that are 90 days in relevance. And what he was saying is, I'm going to get this pump company off of the public sector and we're going to take it private and we're not going to have to report to the SEC every quarter. I'm not going to be plagued by investors who are watching the price of technology stocks go up and down, wonder why I'm not fluctuating with them. I'm going to be able to focus fully on properties, selecting properties, and managing those properties for exit. And that's how I'm going to make value and wealth for our investors. So it's very important to understand that you have to find the right fund and the right manager, but once you do, these are very viable investments for your retirement plan and will add diversity, just like real estate on the ground will add diversity to your portfolio. All right. So that's it for me today. I'm going to turn it over to Hiba Exeter, and we're going to learn about using Rule 1031 to defer gains on commercial and retail properties that we buy and sell. Hiba, the floor is yours.
Thank you. Thank you, Brett. Good evening, good morning, good afternoon, everybody. My name is Hiba, and I am with Exeter 1031 Exchange Services. And today we'll be talking about what is a 1031 exchange. So we serve as a qualified intermediary, which is an accommodator, and we serve as an exchange accommodation title holder, where we have to hold legal title for a reverse 1031 exchange. We cover all 50 states, and actually we're one of the few companies that do foreign exchanges as well. What type of exchanges we do is a regular forward exchange, where you sell your property first, then you purchase the property that you'll be purchasing. Reverse exchange is where you sell the replacement property first, and then you sell the property that you'll be selling. And we'll do improvement exchange and zero equity exchange as well. What it means by real property exchange is only real estate qualifies for a 1031 treatment. Foreign properties as well qualifies, is where it's foreign to foreign, domestic to domestic. Next slide, please. What is a 1031 exchange? Of course, 1031 is an Internal Revenue Code and Section 1 1031 of the Treasury Regulations, meaning basically it is a tax-deferred transaction, not a tax-free transaction. Next slide. What are the benefits of a 1031 exchange? When you sell a real estate, it triggers income tax consequences. So you can defer the taxes by probably planning your taxes for the exchange. Next slide. Thank you. Apologies. Next slide. Thank you. Having said, let's get started on the technical requirements. 1031 exchange needs to get involved prior to closing on the property that you will be selling. That means we have to do three things. Those three things, number one is we prepare legal agreements and related transaction documents. We receive, hold, and safeguard the 1031 exchange funds. We serve as an advisory in the role to guide the clients. Basically, we hold the client's hand from the beginning of the transaction until the end. Next slide. Thank you. Next are the critical steps in completing the 1031 exchange. You have to prove your intent. The more you prove the intent is, the more you can show the IRS that your intentions were to hold the property for rental or investment. So you have to rent it, which is income production, invest, which is capital appreciation, and as well business use. Properties that are held for rehabbing or flipping or wholesales, those do not qualify for a 1031 exchange. basically meaning is that you're holding the property for sale. You're not holding the property for investment purposes. Next slide. In the next area, we get questions on what is a like-kind property. It's very easy. You sell real estate, you purchase a real estate. Some clients say that means, do I have to sell a condo and that means I have to purchase a condo? No, you don't have to sell a condo. You don't have to, you can sell a condo, but you don't have to purchase a condo. You can sell a condo and you can purchase a single family home, or you can sell a condo or purchase a warehouse or a commercial property. Those are considered like-kind properties. And that goes the same thing with the foreign exchanges as well, is where you have to sell real estate and you have to purchase a real estate. Personal properties no longer qualify for 1031 exchange treatments. That means they are considered and run real estate properties. Following is the list, as we mentioned, following is the list of the like-kind properties. So here are the 8 exchange bullet points that you can exchange between them. As I mentioned, you can sell a single family home and purchase a commercial property, or you can sell a vacant land, purchase oil or gas interest, or you can go into a DSD or a TIC, which is tenants in common. Next slide. Let's talk briefly about the 1031 exchange deadlines. Say you close on the property today, which is March 17th. Keep in mind the timeline always starts a day after. The first 45 calendar days is the identification period. And now that we understand this, it's a tough market out there. So here's some backup strategies that we have for our clients, is that you can always delay the closing. You can always start looking for the replacement property. You can go into contract. You can make offers. However, please do not close on the property that you are purchasing until you close on the property that you are selling first. Or you can, as we mentioned, you can go into TIC, which is buying a percentage of the property, or into a Delaware statutory trust, which is as well a percentage of the property as well. Then comes the 135 calendar days. That is the timeline for you to close on the properties that you had identified. It is not 45 calendar days plus 180 days. It is 45 calendar days plus 135 calendar days equals 180 calendar days. And that is the timeline for a successful 1031 exchange. There are no exceptions. Only if the government declares a disaster, we will be notified that there will be exceptions for some of the states, not all of them, depending on what type of exception it will be. Next slide. Once escrow closes, or once the attorney closes, basically once you close on the property that you have sold, you have 3 rules to look at. And you only have to satisfy one of the following rules. The first rule is the 3 property ruling, is where you can identify up to 3 properties. You don't have to purchase all 3 of them. It's a backup strategy that the IRS has given in case one of them falls out of market. You have the other 2 options to close on. On the 45th calendar day by midnight, the 3 or 1 or 2 properties that you had identified will be locked. That means you will no longer be able to modify the form. And that goes the same as well if you plan to do a 200% ruling. The 200% fair market value is you have to you have to identify as much as you want properties. They don't have to be 3. They can be 5, 6, 7, or 8. As long as the total value you identified cannot exceed 200% of the sales price. Then comes the 95% exceptions. In my 11-year career, I've never seen it. I've just heard about it. I mean, if you identify more than 3 properties and more than 200% value, you qualify if you close on 95 of the properties that you have identified. That is a very complicated exchange. That means you have to close on 95% of the properties that you had identified. And what we mean by identifying is that you have to provide us with an address of the property that you're purchasing, or APN number, the parcel number that you will be providing. And once you do identify, the identification form needs to be submitted to the qualified intermediary, which is us, no later than the 45th calendar day by midnight. The third area that we get questions about, how can I defer my taxes, or how much can I defer my taxes? In order to defer all the taxes on the capital gain, you can trade equal or greater to the property that you have purchased. Number two is that you have to reinvest 100% of the equity or cash proceeds that you put in. That basically meaning is that you have to replace the debt or the cash. You can withdraw cash, but it will be considered taxable boot. A partial exchange does qualify in a 1031 exchange, but it will result some tax, and that will show more in the next slide. You hear a lot about you must equal, as I mentioned, you must trade equal or greater in value. That is correct in order for you to defer all the taxes on the capital gain. Partial exchange are okay. They don't harm it. You just have to pay taxes on the difference. Pulling cash from the proceeds don't harm it as well. As I mentioned, you have to pay taxes on the difference as well. Trading down in value, say you purchase for $1 million and you want to purchase a property for 700, the 300,000 will be considered taxable boot. And you can obtain a larger loan, or you can come up with cash. And that was a quick and very simple explanation of a 1031 exchange. Now I'll turn it over to you, Johnny. Thank you.
All right. Awesome. Well, welcome everyone. I'm Johnny Lynum, founder of REI Genius, retired Air Force Lieutenant Colonel, licensed financial advisor, and active real estate operator with the portfolio built over the last couple decades. Before we dive in, I want to acknowledge something. If you joined today and any of those statements on the screen sound familiar, I don't know where to start, or I've been waiting for the right time to start investing, to make that first investment using my self-directed IRA. You are not alone. I promise you, you're not the only one having that hesitancy or really operating with that fear around making the next step. And more importantly, you are not behind. So the thing that most investors are missing isn't motivation. It's not even money. It's having the right system in place, a repeatable framework that cuts through the noise. And that's what today is about, is giving you that framework, that decision-making process, so you can make that next or your first investment. Let's get started. So let me give you 60 seconds of kind of context on why I'm qualified to walk you guys through this. I've been an active owner now in real estate for over 15 years. I bought my first property in 2006, using my VA loan benefit, my first duty station, knowing that when I leave there, it was going to be that first rental property for me. And then just over the years from there, my wife and I, we started our fix and flip business back in 2015, did our first property in Alexandria, Virginia. And subsequently after that, we started flipping homes one after another in Birmingham, Alabama, where she's originally from. And it just grew over time. We were present in Panama City, Florida for Hurricane Michael in October 2018. That next year, 2019, we ended up doing 12 fix and flips. We bought our first commercial property, an 18-unit apartment in 2020. And since then, we've purchased 4 other apartment complexes in Montgomery, Alabama. And so just everything that I'm giving you guys is from no kidding ground, boots on the ground experience. And all at the same time, I was leading, our real estate operations. I was active duty. And so it forced me to build the framework, to build those systems in place. And I wasn't co-located for the majority of those deals. I was hours away where I couldn't just get to a property. And so I had to build the right team around me, whether it was property managers, contractors. And so, I was blessed last year to retire after 20 years as an acquisition officer in the Air Force, and now operate full time as a financial advisor, really focused in on those multifamily funds that Brett talked about, those private placement opportunities, those Delaware statutory trusts, and really help real estate investors make educated and informed decisions to make sure that they're managing their risk profile properly. And so at the end of the day, what the military taught me above everything else is this: process protects you when emotions run high. And that mindset is in the DNA of everything that I teach. And so about 3 years ago, I started REI Genius, really consulting and helping veterans and helping everyday real estate investors make informed decisions and give them the system framework to help them become successful. And so that's what today's goal is. So let's name the real problem. Most investors aren't failing because of lack of effort. They're stuck in one of the 4 traps that I have laid out on the screen. Whether it's information overload, there's conflicting data everywhere. You have a soft landing, we have a recession incoming, rates are up, prices aren't going down. Some say prices are crashing. We have the war with Iran going on right now. We have the proliferation of AI. None of us know if we're going to have a job in 6 months. And so there's just information overload on a daily basis. And the majority of it is negative, which feeds into the fear that drives number 2, the analysis paralysis. And so if you wait, you're looking for those better rates. You're looking for the correction. You're looking for more certainty. But meanwhile, time continues to come along. Time compounds against you. And then a lot of times, from working with clients, fear of being at the top, buying at the top of the market. And you wonder, is now the wrong time? Is it the right time? What if prices are going to go down if they're not sustainable? And then lastly, the framework gap. And here's the honest truth. Most people don't lack the motivation. They lack having a repeatable system that works regardless of what's going on in the economy, the market conditions, what's happening at your day-to-day job, and understanding that everything that we're going to cover today is designed to help you solve that 4th problem. Because when you have the right framework, the first 3 don't even matter anymore. And so that's where we're going with that. Next slide. So let's talk about the data and see what the data is telling us right now. So we're going to start with supply. This chart right here illustrates that, something doesn't necessarily get a lot of airtime, I would say, when you see a lot of the news cycle. But for the casual real estate investor in the conversations that right now, fundamentally, the United States, that we have a structural housing supply deficit. We are millions of units short of where we need to be to meet household formation demand. This isn't a cyclical trend. It's been building for over a decade as we came out of the Great Recession, and then it got compounded by the pandemic-era construction slowdown, labor constraints, and zoning friction that we see in some of the high-demand metros like Austin, Texas, Phoenix, Orlando, and some of those areas. Some a little bit easier to work with than others, but all these headwinds have really slowed down the building and the supply that we need from a housing perspective. And so what does this mean for you guys as investors? Durable demand is baked into buying real estate and owning real estate. You're not speculating on a trend. You're invested in a structural imbalance that isn't resolving itself anytime soon. Next slide. Now, affordability. I know that some of you are thinking, hey, if it's not affordable, then how's it a good time to invest in, to buy real estate? Great question. Here's how to think about it. Low affordability doesn't mean weak demand. It means demand shifts from being an owner to becoming a renter. And now people, they can't buy, so guess what? They're going to rent, and often for a longer period. And if you kind of look at the data, the chart on the left, that you'll see homes have not been this unaffordable in nearly 40 years. You go back to the mid-1980s. And then on the right side, you see where the cost of ownership is today in comparison to rent. And it's over $1,100 cheaper to rent right now across the United States than owning. And of course, we know real estate is local, but this is looking at the broader United States and just what the average home price, purchase price is right now across the US based off global national rent prices. And so we can see right now, more individuals are choosing to rent than own just because of, number one, just the affordability. And so really diving into this, and when you look at for multifamily investors especially, this is a big tailwind because elevated rates, sticky prices have actually strengthened the overall rental demand. And today's challenges are benefits for those that own real estate, especially when we start looking at inflation and the impacts that the economy is having right now, as well as a potential uptick that we've seen here most recently with unemployment, that being able to hedge against inflation is going to be a great benefit as we go into the future. Next slide. January is typically a slow month for rent movement. That is show, looking back in January, this time positive rent growth across most markets, which is normally, it's a signal worth bringing up because normally we don't see a lot of movement in the month of January. We're coming out the holidays, coming from Thanksgiving into Christmas. A lot of people are moving. And so as an owner, a lot of times we're just happy to get an application to come in for that vacant unit if we have a vacancy. And so one of the things right now we're seeing is that prices actually went up, looking January over January, comparing back to January 2025. And the point here isn't to predict the future, but it's to really to show you that the macro environment support that the investment thesis that we're continuing to build on with real estate being positive. Rents are starting to go back up. There was an overbuilding of supplies. We kind of go, and we'll see on the next slide that right now the demand is meeting where supply is and going into long term on what the benefits will be. And we'll show a little bit of chart as we go into the next slide, actually, that'll talk about kind of multifamily and the vacancy. So here's a counterpoint, so really, I want you guys to be able to see this clearly, that because having a complete framework, it requires you to kind of have honest underwriting at the end of the day. So multifamily vacancy is elevated right now. New supply that was permitted and started back during 2021, 2022. It takes a couple years to build these new units, to get the permits in place, do all the entitlement up front. And so with that construction boom down during that period, all those units are now delivering to market. And so in certain metros, particularly across the Sun Belt, that you're creating a short-term vacancy pressure. So what does that mean? Prices have to come down because guess what? Renters, they have more options to choose from. There's more inventory. There's more new units to choose from. And so you see anywhere from 1 to 2 months of concession, security deposits cut in half, just all type of concessions and incentives to get more people to fill up these units. And so for sophisticated investors, this is actually a great buying opportunity. Sellers are facing lease-up stress and higher vacancy environment. And guess what? They're motivated. A lot of the loans are coming due, and the entry cap rates right now are improving. And so on the supply pipeline beyond 2025, we see that it drops off sharply, meaning the absorption window is finite. And so as we look at 2027, 2028, that we're walking through, that things come back into balance. And so those owners now that are acquiring properties, that they're moving in to being in a great position when they meet that future demand when more units are dropping off. And we see that huge spike in the orange right there, 2021, 2022, and the blue deliveries that subsequently came in on 2024, 2025. And so as those ramp off, it's going to be a great opportunity for those investors. And I'm seeing it right now on the institutional side with individuals, they're buying 20 to 30% below 2022 highs on commercial real estate right now. They're buying 2 to 3 year old properties for 20 to 30% off right now. And so for investors that are on the sidelines that are looking, this may be a great opportunity when you start looking at the right operators that have been doing this for decades and experience, that have the vertical integration with property management, contractors all in place, that have a great track record. This may be an opportunity for you to align and being able to meet this upcoming demand with these great Class A multifamily properties that are being acquired for less than what they could build a new building for right now, with all the increase in expenses as well as in labor and material costs. Next slide. So where's the opportunity? And so when you look at 7 to 14% annual IRR across structured real estate investments, when you underwrite correctly and really look at this, you should be somewhere within that window. It's not a promise, but it's a kind of documented benchmark, across institutional style deals, or where you need to be looking at kind of where your returns are kind of where they're going to land at. Zero tax on gains when invested through a properly structured self-directed IRA, particularly a Roth self-directed IRA. And Exeter can kind of help you guys with that. But this is one of the most underutilized strategies that I see with clients that I work with, is not being able to leverage their self-directed Roth IRAs to own real estate, to have real estate exposure, where now all those gains are growing tax exempt. And so I think that's one thing to look at. And then lastly, the 5 years to a wealth position, that I've watched one well underwritten deal change a client's entire financial trajectory. I'll tell you, on my first 18 unit deal, I didn't do it in an IRA, but buying at the right price, that I was able to increase value over $400,000 in less than 2 years in 2022 when we did a refinance, where essentially received all our capital back in the deal, and then an additional $300K that we had that was tax-free because it was rolled up into the loan. And here recently, back in January of this year, I sold that property where it appraised, where we initially had $1,050,000 purchase price, and only 5 years later that we were able to sell at a price of 1.6 million. And so one of the things that I tell you, that being able to get into the right deal and let time do what it's going to do, because I had no way to know buying in 2020 and going into COVID because it was scary as hell. March of 2020, we went under contract, and 2 weeks later, everything shuts down across the country, to know in just 5 years the run up in appreciation that we would have with inflation and everything. And so the thing is like the best time to buy real estate was 20 years ago, and the next best time to buy real estate is today. And so being able to leverage these fundamentals and the framework details that we're about to dive into is going to really pay dividends for the investors that take action. Next slide. I want to be direct, because at the end of the day, you can't scale on a gut feeling. That, a lot of times we fall in love with properties. We may underwrite 6 months, deal after deal after deal, with not making any progress. And then we get the one, and we get in due diligence, and we kind of turn a blind eye to a couple of things. We try to go back and re-update our due diligence numbers to make it pencil in and work. But guess what? Here's the framework that you really need to operate around. 3 pillars that separate consistent investors from one deal wonders. Number 1, systems create consistency. Having that framework in a high interest rate environment is a bulletproof framework. Because guess what? If your deal works at if it only works at 3% interest rates, it never was a real deal. Number 2, structure removes the emotion from the equation. Underwriting tells you no, so your excitement doesn't tell you yes. The spreadsheet is your emotional governor. Too many times I see clients that I work with where I just love the deal. It's right down the street, and I know we can increase rents, but we don't buy it at tomorrow's value or what the value will be at next year. We're buying at today's net operating income, today's value. And so having that structure, it allows you to take the emotion out of your decision-making process. And then lastly, repeatability. The goal isn't one great deal. It's a process you can run again and again across different assets, markets, and economic cycles. This is the philosophy in these 3 sentences that let you build out each layer of your framework. Next slide. Every deal starts right here with a selection, making that decision. And most investors skip this step or do it too superficially. And looking at number 1, market fundamentals. Is there job growth? Is it population growth? Are people moving here? I did a LinkedIn newsletter at the beginning of the year that looked at the U-Haul data. This data tracks all the one-way U-Haul moves, and it lets you know, hey, some of the usual suspects. Texas reclaimed number 1. Florida was right there behind. You had South Carolina, North Carolina on there. Where I invest, Alabama, my backyard was number 9 on that list. And so you go through and kind of look at the data and understand where the jobs going, where are people moving to, because they're going to need somewhere to stay. And we already saw the data. The majority of them are going to choose to rent when they move there and not own a property. And so I think that's where we see a lot of the build to rent, where, right now the current administration is going after the big institutions that are buying real estate. But at the end of the day, you're only talking about maybe 4 or 5% of all single family inventory is owned by institutional funds. And so not a lot there. But now you see the rationale why you have institutions that are building entire subdivisions dedicated just to renting property, because it's a great hedge against inflation, and they understand the trends where jobs are moving and where people are moving to, that housing is going to be needed. And right now we know that we're undersupplied just because we haven't been able to meet that demand over the last decade. Number 2, property fundamentals. What's the physical condition? What's the deferred maintenance picture? A $50,000 surprise is not what you want after closing on a property, because it can ruin your overall performance. And so this is one of the things where you want to look at. You want to check out the electrical. You want to check out the plumbing. You want to check out the age of the roof. You want to understand the age of the building and understand, okay, what has been replaced? What is going to probably have to be replaced under my watch? And do I have enough money set aside for it? And based off of all this money that I'm going to have to put in to repair these things, is this going to be a viable investment based off the cash flow and the amount of money that I need to deploy to bring it up to today's standard? What is that return on investment? Am I good with that return on investment? The answer could be yes, and it could be no. But going through this process is going to allow you to know without a shadow of a doubt, hey, going in, I made all the right decisions to know this is a sound investment. And guess what? At the end of the day, you still won't know 100% what's behind the walls and what's going to come, but at least you did the most amount of due diligence you could up front. And then lastly, the value creation potential. This is where I love to operate. How can we increase the net operating income through better management, operational efficiency, reducing expenses, or doing some light renovations to increase rents? And so really, one of the things that really brought us into our focus area, my wife and I with our company, was really being in, knowing our niche with value add, entry level housing, and being able to go direct the owner to buy property, because there lies the real opportunity. Because most owner operators, they defer maintenance, they don't keep up with maintenance across the board, they don't run it as a business, they're not keeping up with inflation and increasing rent 3 to 5% usually every year. And so being able to go in and find an owner who's owned 10, 20 years to go in, that now you can go in and improve expenses. You can look for economies of scale, that you can bring in. You can renegotiate landscaping contracts. You can hire, better contractors to come in and renovate and charge $200-$300 more. And this is where the opportunity to increase that NOI is really going to take you to the next level and make sure that you have a sound investment. Because at the end of the day, risk begins at selection. And if you choose well here, everything downstream gets a lot easier. Next slide. So underwriting. So really this is the engine of the vessel. Everything else is really context, but underwriting is where decisions get made. And so the three numbers that I want you to walk away with that you need to know code on any deal is your gross operating income. How much income is this piece of real estate going to generate? How can I add other income streams? How can I subtract? You want to make sure that you also subtract vacancy losses to make sure you have a realistic top line number. Secondly, you want to move into operational expenses, your taxes, your insurance, your utilities, maintenance, management fees, repairs. You want to understand everything that you're going to be required to spend capital on when you have this multifamily or this property stabilized. Normally, we're going to see expenses somewhere for a non-new build, but I would say anything older than 10 to 15 years old, that your expenses are going to run somewhere 40 to 50% of your income. And if you have a seller that's telling you that, hey, their expenses are 30%, or even I've seen even less, like, how are you operating at 20% expenses? That should be a red flag. And so you want to definitely do more due diligence on that. And then lastly, your net operating income. So it's just simply your gross operating income, how much money the property is going to produce, subtract your expenses, and then that number that you come up with, that net operating income, the NOI, that's the number that's going to drive your valuation. The NOI divided by your target cap rate gives you that asset value, what the asset is worth, independent of finances. So not looking at debt, but just really looking at, hey, based off what in this capitalization rate, what are investors paying for this level of income in this market? And how does this compare based off the price, that the offer price or the price that the seller counters back with? And so it gives you that barometer where you can compare apples to apples in that market. And here's a line that I like to leave all my clients with at the end of the day. Underwriting is the bridge between a house and an investment. Without it, you're making an emotional purchase and you're calling it a strategy. And so having the numbers and having that rigor behind it is going to set you up for long-term success. Slide 12. So underwriting tells you if the deal makes sense today, and then the stress test is going to tell you if it survives tomorrow. And so really, before you close any deal, you really want to look at and run scenarios. Hey, what if my vacancy hits 10%, 20%? Where do I break even? Where the property is self-sufficient and takes care of itself. If the deal still survives its debt and cash flows in these different scenarios, you want to move forward. It's a solid deal. But if it doesn't, you walk away. And so the thing is, you want to be able to make sure you're stress testing your deals. You want to look at professional management. Self-management is an execution risk. The moment your portfolio requires more than you can personally oversee, that's when you need to lean on your systems. And being able to have professional property management allows you to have that ability. I've been there. I've self-managed single family. I self-managed my 18 unit the first 6 months because it was during COVID. I had reduced work hours, and I knew I was leaving November of the year and coming back to the Northern Virginia market. And the best day in my life, besides giving my life to Christ and getting married, was handing over those keys to the property management company, because it was a grind. You had people who had to sob stories. It was always this, that. You had one person that wasn't paying. And then as soon as you get you bring in the property management company and they're 4 months behind, and magically they come up with $4,000 in 3 days to pay all their back rent, because now the management company is like, hey, this is unsatisfactory. You're going to end up getting evicted. And so it's things like that, with having that, running it as a business, and you being able to focus on your next acquisition and not really worried about, the $100, $200 task of managing your one rental and calling the plumber, calling the handyman, and letting someone else collect rent. It frees you up to make larger, more strategic decisions for your portfolio to get that next asset and not the day-to-day grind. And then lastly, the institutional thinking. This is the mindset shift that separates operators from speculators. Institutions, they prioritize durability. Brett talked about just that long-term survival, that durability. They focus on that over speed. They're not chasing quick flips. They're building structures designed to compound over time. And if you adopt that mindset, and I promise you, you'll make decisions that hold up across multiple market cycles. And that's the thing that we see with the great operators. They've been around decades and decades. They know when to buy, when to enter the market. They follow the cycles, and they're following the data to make informed decisions. And we should be doing the same thing too. So 3 ways to invest in real estate. This is where really you can figure out, how do you fit in with where you are right now, whether you're looking to leverage your self-directed IRA, you're thinking about doing a 1031 exchange. How do you want that next acquisition to look for you? So a couple ways you can look at it. You have direct ownership. So single family, small, multifamily, you find it, you buy it, you can manage it, or you can get a property management company. You have full control. Direct equity growth is right there. Inside of your self-directed IRA, an all cash purchase, it eliminates the UBIT tax or UBIT, and allows every dollar of appreciation and cash flow to compound tax-free. In that scenario, you want to target your internal rate of return to be somewhere 7 to 12%. Multifamily, they're in the middle as a value add. Anywhere 5 to 20 units, could be more, but you're using leverage and operational improvement to force that appreciation, creating that equity rather than waiting for it. And that's what I love about multifamily, where we don't care what our neighbor down the street sold their property for 3 months ago. What we're looking at for our valuation is, how good are we operating our business? How good are we operating our apartment in generating income, reducing expenses to drive that net operating income? And so in this case, with a non-recourse debt at 65% loan to value in your self-directed IRA, you preserve the leverage while still keeping the UBIT minimal. And so you want to end up, when you're looking at your IRR, you want to be somewhere 10 to 14%. And then lastly, for the passive limited partner, investing in the fund, like Brett mentioned earlier, you invest as a limited partner in a professionally managed fund. No tenants, no toilets, no termites, no calls at midnight. This is the path that really lays out for most busy professionals who want and know they need real estate exposure without the operational involvement. And so the self-directed IRA invests directly into the fund. Exeter, of course, they manage all your compliance, your documents, because normally with the fund model, you're going to have a subscription agreement. You're going to have a private placement memorandum that you're going to have to review and sign. And then you're going to also probably have your operating agreement that you need to agree to and sign off on. So it's a little bit more cumbersome. Sometimes some of these funds, they are assigned or are allowed only for accredited investor that has made $200K in household income as a single individual the last 2 years and expect to make that going forward in the next year, or $300K for a married household the last 2 years, and with the expectation they would make that going into the next year, or $1 million net worth, not counting their primary residence. So those are kind of the definitions of how you can be dubbed the accredited investor. Your CPA can write a letter, and there's some other ways where you can be accredited. But just being accredited allows you to open up the aperture for so many different opportunities to invest in the limited partner funds or other alternative investments that you can leverage using your self-directed IRA. And so kind of looking at, I want to roll next into a few case studies on what this would look like in the asset class. And we'll kind of make it real and bring it to life for you guys. So this one here, case study number 1, 3-bedroom, 2-bath, single family rental in a Midwest growth area. You're looking at an all cash transaction out of your self-directed IRA. So $250,000 is the purchase price. So looking at the underwriting. So we're projecting the annual price growth in this market 1.8%, somewhat conservative. Annual cash flow at 5.5% yield. So roughly $13,800 a year. We're going to exit in 5 years. And so we're going to exit, taking that price appreciation to account at $274,650. So the result of that 5-year hold, around a 7.35% annual IRR, tax-free inside your self-directed IRA. But here's the number that matters the most for high earners in the room. A tax-free 7.35% return is equivalent to roughly a 10.5% taxable return, depending on your tax bracket. And so it's not a flashy deal, but it's a durable one. It's institutional thinking and action. So really going through, we're hedging against inflation. We're in a non-correlated asset to the stock market. And we're prioritizing that long-term yield in a high-rate environment over chasing potential upside and for appreciation. So case study 2. So we're going to look at the multifamily side of things. And so we're going to step up in scale. So this one, a 10-unit class C, I would say C plus value add apartment building. So on the acquisition side, your purchase price is going to be $1.15 million at an 8% entry cap rate, meaning the market was pricing this asset for its current performance. We're not buying on where we can take the NOI in the future, but this is just based off today. And so the strategy with this is non-recourse debt at 65% loan to value. Total out of pocket for your self-directed IRA is going to be $500,000. So $420,000 down is the down payment, and then $80,000 for capital reserves for the renovation work. So year one performance, annual cash flow of $36,478. So roughly 7.5% levered yield before any value creation. So the business thesis on this one, you want to increase that net operating income to $92,000. So through professional management, putting systems in place, reducing expenses, and capital improvements. So on this one, every dollar of NOI growth at a 7% exit cap rate creates $14 of equity value. So that's really just looking at the pure math and why this operational improvement is the real investment strategy. And so really looking here, fast forward 5 years, what does the exit look like? So exit price, $1.314 million, driven entirely by the net operating income, not comps down the street, and really not any type of market speculation. And then the total annual internal rate of return, 11.9%. So approaching that institutional big benchmark of 14% weighted IRR kind of for this asset class. So the 3 lessons to really lock in on this multifamily case study 2. 1, systems created the return. Professional management, due diligence up front, underwriting the deal, and having a business plan going into it. Number 2, every dollar of net operating income growth created $14 of equity at a 7% exit cap rate. This ratio is why operators focus on net operating income and not just cash flow. And then lastly, number 3, this deal worked in a high rate environment because it was underwritten for it upfront from day one. We make money in real estate when we buy, not when we sell. Say it again. You make money in real estate when you buy, not when you sell. All right, let's look at case study number 3, the last one here. This third path, and arguably I would say the most powerful for the right investor profile, is the limited partner setup, leveraging your self-directed IRA. So in this scenario here, case study 3, the limited partner interest is in a 200-unit Class B multifamily fund in a Southeast growth market. So your contribution, $100,000, all cash, so 0 UBIT. And the structure, so 7% annual preferred return, then a 70-30 split on the upside. So that means all the investor capital coming in, the investors get 70% of all the equity that's created over the whole period. And then the operators, they get 30% of the upside. So it's a 5-year hold with a projected 12 to 14% IRR. And that's just based off how good is the operator at executing the business plan. And so this one, I'll kind of pause here and really talk about, being able to do your due diligence on the operator, making sure they have a great track record. They have an experienced team. They have an experience in that market. They have experience in this asset class of real estate is really paramount, because right now in this as a fund and invested as a limited partner, you're beholden to the operator, because guess what? You're not having any control in this, and you're just really going on for the ride. And so the jockey that's driving the horse is extremely important in this situation. And so that's one of the things, as a fiduciary, as an advisor with the private placements, we do due diligence on sponsors. We go to their headquarters. We ask the tough questions. We talk to the operators at the property managers. And so we're going and understanding, making sure, especially for me and having an operational background, with what I do in the military, that I really geek out on the ops and, being an owner, because I manage my properties, and the asset management side is where the rubber meets the road, because bad management can ruin a great deal if you don't have the right people on the ground with the day-to-day execution. And so having the right operator and understanding the right questions to ask these people is extremely important to make sure you're doing the proper due diligence on the operator, and then really looking at their track record. How experienced have they been? Have they been in a downturn? Have they gone through different cycles and have that experience where now they know how to operate when the economics change in the marketplace? And so getting back to the deal, so looking at the results, so 100K all cash investment in your self-directed IRA, 7% annual preferred return, 70-30 split. So the total return after the 5 years would be somewhere 167 at 12% IRR to 193,000 IRR. And this is tax-free inside your Roth self-directed IRA. And then the kicker with the tax-free 13% IRR, kind of going back for those high earners that are the highest tax bracket, now that's equivalent to 18.5% taxable rate of return. And so that's the structure with looking at how you're able to compound interest and create wealth at an accelerated pace by being able to use the right vehicles that you have at your disposal. And then the really kicker for this is no tenants, no management calls, no operational risk. You have an expert that's had decades of experience, billions of dollars assets under management. Their expertise, they handle 100% of the execution, and your self-directed IRA holds the position. And in this case, Exeter, they can ensure that you're completely compliant with the IRS throughout the holding period as you're owning. And so this is one of the hands-off wealth building strategies. And for many of you in the room, it may be the most aligned. And so kind of on the next slide, just bottom line, you got to know the market. Housing supply gaps, affordability pressure right now is creating durable demand across the board, not speculation. The macro environment right now is working for us as real estate investors. Underwrite rigorously your net operating income, your cap rate, your debt service analysis. Being able to go through these things, it beats your gut instinct every single time, always. Use the right vehicle. Whether you're a direct real estate owner, you're looking to invest in the fund, or you're looking to leverage your self-directed IRA, the structure you choose should really match your goals, your timeline, and your tax situation. And Exeter is a great partner for that in getting that structure right. And I would love to have a conversation with you guys. If you're looking at a financial advisor and really want to look at a holistic understanding, hey, what does this transaction mean to me and my broader wealth? Would love to have that conversation. And I think then lastly, understanding how to partner wisely. I think you guys understand the value, of course, what Exeter brings to the table. You wouldn't be here, and then just really, being able to make sure that you have the right people in your corner where you're making informed decisions and leveraging other individuals' experience to make sure that you're setting yourself up for long-term wealth. Because at the end of the day, sound real estate decisions, they're not made by the loudest voice in the room or the hottest tip on social media. They're made by investors who know the numbers, own the process, and use the right structure. So my last slide here, education without execution is just entertainment. That's a line that I take to heart and mean, because guess what? Today we gave you the framework, but a framework, it only creates wealth when it's applied to your situation, your capital, and your goals. And, for those that are here on the call, I'll offer up a private wealth assessment, just a conversation to really kind of map out your current position, where you're trying to go the next 3, 5 years, even further out than that, and really determine, whether direct value add or maybe a passive self-directed IRA strategy makes the most sense for you. So you guys, you can book a call there, johnnylynum.com/alignment, or there's my email address, phone number, and would love to, see how I can be a resource and add value to you guys.
Okay. Thank you, Johnny. Thank you, Hiba. So we've had a few questions posed during the course of the presentation, and I think we answered those questions. I'll give it a few seconds here for any other questions to pop up, and then I'll give you our closing comments. All right. Doesn't look like we have any additional questions. So our contact information is listed here. Again, you can get in touch with all of us. You're not going to get a text back. We like picking up the phone. We like talking to people. So don't be shy. Call us and share your creative ideas with us, and we will help you through those. 4 comments before we leave. Have a tested system. Have a system with tools that works, that works, and utilize it. Don't stray from it. Use an eye to diversify. I would never tell you to sell out of all your stocks and all your mutual funds and all your bonds and buy everything, into real estate. Real estate is the diversifier. It supplements what you already have in your portfolio. Okay. Ways to defer. You don't have to utilize an IRA. Obviously, that's encouraged, right? Why not? But you can utilize Rule 1031 outside of an IRA to defer gains and to grow wealth faster. Keep that in mind as a tool. And then keep an eye to the long game. Retirement plan investing is not a one and done. It's not quick. It's for those who want to stay in the game for a long time. So utilize that system, wash, rinse, repeat, and build your wealth over time. Thank you all for attending. Thank you very much. Bye.